Good morning. I'm doing a morning shoot this week. Hey, it is Friday, June 17th, the day after my anniversary. Actually taking the day off, so I am shooting this from my home office, so thus I have blurred the background, so you cannot see my beautiful home office, which behind me there's really not much. So I figured I would just blur it out so we would not have any distractions for the day, because I've got a really big day today. I miss you guys. Hope everyone is doing well. I've got a really big show today, as I said, and as I would like to kick things off, as normally we go, we have the disclosures where, everything on this show is believed to be true, although you are supposed to fact check me, essentially, is what I am told to do. Investments can and will lose money. They are not FDIC insured. This is not investment advice, accounting advice, tax advice, legal advice, and what other advice I could give on this show. Without further ado, we're going to get moving forward here on that. But I am going to real quick to my disclosure, so you can speed read that here in about 10 seconds. And we'll get going here. At the end, there will be a test. So I hope all of you have a number 2 pencil in your Scantron, as they used to pass out when I was in college. And, we will have a test. I'm kidding. Welcome, everybody. I tell you, for those of you joining me for the first time, Wall Street is X's and O's is really a show that I do every other week. I really try to focus on all the things that aren't being discussed or talked about in the markets or on TV and the papers that I really think are important, and I think there are things that people are missing. I also try to focus on things, I'm big on truth or truths, as those of you who know me personally and have worked with me for so long, that's really important to me. So I really try to dial into those truths or non-truths in some cases, which we're going to talk about one of those today. But I've got a really good show today. So again, for those of you joining me for the first time, this is uncut and unedited. I always use my John Daly analogy with you. If you're a golfer, you know who John Daly is, and he just gripped it and ripped it. If you don't, look up John Daly. Check out the dude. He could hit the crap out of the ball. I tell you what, but many times you didn't know where it was going. So that is very reflective of my show. Anyway, top 3 things. Volatility update. The VIX continues to be precipitously rising and elevated. We're going to talk about those that risk paradigm again, just to remind people of what to keep their eyes on. The QQQ, which is kind of a NASDAQ 100 index, the bubble's really popping there, and we're going to really dive into those numbers and really what that is looking like. And then also from a standpoint of interest rates rising, they're not just rising here in the US, they are rising globally. And then obviously I close it out with my infamous things that make you go, and no, I'm not going to sing. I actually played music one day. I didn't feel that went over well, so I have banged it. So I just now am just going to say the Anyway, moving on. Here we go, volatility regime. For those of you who have been with me for quite a while or have been listening to these shows for quite a while, I talk a lot about volatility. Volatility tends to drive market performance. For instance, I create 3 buckets. I call this a volatility regime, okay? When the VIX, and what the VIX index is, it measures the inherent volatility in the options market. What does that mean, Craig? Well, when big hedge funds and institutions are going out there and trying to hedge or protect their book of business or increase and leverage their assets to go bigger for longer or on the long end of this equity world as we know it, you really see it in the VIX index, which is really a measurement tool. So again, quick review. VIX index level between 1 and 20, stocks are moving higher. There's really not much that's going to get in their way, and they're going to keep cruising higher. It's a great time to own equities. When you have a VIX between 20 and 30, I call this the chop bucket. Buyer beware, because what happens is you get volatility rising, and when it rises above 20, normally it's going to head a little bit higher, of which that means the market is exhaling or moving down. That tends to suck people in at the wrong times. So you'll see spikes in the market. People will start buying, ooh, the market's safe. It's really not. And, the market sells off again. So that's why I call this the chop bucket. A VIX, when it is above 30, I call this the F-chuck bucket. Equities are uninvestable at this point in time. As of this moment, as I shoot this here on Friday morning, the VIX is at 31.53. It's actually down $1.37. But again, over 30. That really is a great depiction of what the markets have been like lately, which they've been very, very tough. If you've been an equity owner, particularly certain parts of the equity world, you're experiencing some pain right now, and it has been very, very tough. Let's take a look here. This is some good stuff. I got to get my little pointer here. I don't want the laser pointer. We're going to do this deal. This is a chart here of the VIX going back 10 years. So this is 2011, clear over here. Here's 2012, 13, 14. You can see it down here on the very bottoms of my screen, okay? Here's what's interesting. Every time we get one of these increases in the VIX, this is the S&P 500 here, this little gray squiggly line, okay? What you will note is that every time we get a rise in the VIX, what do you see the market do? Sell off, sell off, sell off. This is actually the last time right here when Fed Pal tried to raise rates back in 2018 going into the end of the year, and it just blew up the market. It erased all the returns that we had gotten year to date. I was very angry that year because we were having a really good year going into October, November, December, and Fed Chair Powell just killed us. And then here you see how the markets bottomed out. Well, he freaked out about trying to raise rates too far, too fast. You know, history, I don't know. I'm going to touch on that later. Then you can see how he changed his mind. What happens? VIX goes straight down, markets go up. Now, this is the pandemic. You can see how the markets peak here, markets drop off, pretty intense pullback. Now, another thing you're going to see is how markets have really bottomed over here from a standpoint of low volatility. You can kind of see this trend here. What do stocks do? Stocks went straight up, didn't they? Now, switching trend, what's happened? You know what? We've seen this sell-off here. We got to keep our eyes peeled. That's why the VIX is critical. Every day, watch the VIX. Remember the three buckets. That's all I can tell you, okay? Moving on here. The QQQ, NASDAQ. NASDAQ peaked in November 19th of last year, all right? I've been talking for months, actually quarters, about how too many people own too few of companies, meaning the big tech names, the Apples, the Microsofts, the Amazons, the Facebooks, or Meta now as it's called. You like how they're trying to change how the company is viewed? We're going to change the name, and maybe people will feel about, you know, what rubbish we throw out there and how bad Facebook is for people. It's kind of funny. Anyway, Google, Amazon, you can throw Tesla in there. Lots of stocks with great octane. As you can see, tech stocks have been overly owned, meaning everyone on the planet, and that's an exaggeration, but probably not far from it, has owned a lot of those names that I just mentioned, all right? We've had very narrow participation, meaning those companies really led performance and have led performance for so long that I've been concerned about what happens when the tables turn and we start heading to tough economic times, and I think we're seeing that right now. If you go back to the last 10 years, tech stocks have been up 336%. If you go back to the end of last year, they were up 532%. That's a pretty nice drop just here in 6 months. Here's a fantastic statistic. Since January of this year, markets or investors have lost $9.5 trillion in assets. During the global financial crisis of 2008 and 2009, they only lost $8 trillion. So if you think about this, we have already experienced a market drop that has exceeded the investment value of the financial crisis in 2008. People say, oh, well, that means we're probably about done. I'm not saying that. I'm saying that this market has had so much fuel in it, so much hot air in it, it's pushed it up so far so high that it's going to erase and it's going to reset itself. These are actually happy times in the market. I've been talking to a lot of you lately, and I've been telling you, hey, I'm actually happy about what's going on. And you say, well, Craig, are you losing your mind? Only partly. Markets, when they go up too far, too fast for too long of a period of time, have to reset. Okay? Now, granted, during that reset, it is very painful for investors. It's painful for us. That's how do we combat that, is with asset allocation and not just sitting there hanging everything in the wind for it to blow us around. No, so this is a good time. It's also a painful time. You know, what does this mean going forward, or what do I expect going forward? I expect some more pain here because the Fed's not done raising rates. And if they continue to raise rate at this pace, anytime you're in an interest rate rising period, which we are here in the U.S., we are here globally, emphasis on globally, that's not good for stocks. Okay, so keep your eyes peeled on that. Moving on here. Year-to-date performance. These are some of the biggest names that people own. Apple's down 26% year-to-date. Microsoft 26.4, Amazon 37, Google 26, Tesla down 38, Meta, which is Facebook, is down 51, and the infamous Netflix is down 70.48%. Those are big numbers. Lots of people own these stocks, not just individual investors, but institutions, hedge funds. You know, you've got lots of people that think they were genius investors because they own these companies the last 10 years. I'm telling you, they just happen to own the right companies, and everybody piled into them, driving prices higher. Stay tuned. This is going to be fun to watch. Interest rates are rising globally. As I said, this is not just something going on here in the U.S. This is a global deal, okay? And when things are globally impactful, the impact can be greater sometimes, okay? If you look at it, the Federal Reserve has already raised rates by 1.5% this year. We started out the year with a 50 basis, or actually 25 basis point hike, I think. It might even be up 75, but they started with 50. I think they already started with 25. So you can tell that this is just uncut and unedited because I'm arguing with myself, essentially. They started out the year with a 25 basis point or 1/4% interest rate hike. Then they went 50, then they went 75. So we're at 1.5% year to date. Yesterday's interest rate hike was the biggest that we have seen since 1994, as you can see here. The Swiss Federal Reserve increased rates by 0.5% overnight, which you think, well, that's kind of what we did. Here's the problem. This was a surprise. They weren't telegraphing that at all. It was the first rate hike that the Swiss government has done in 15 years. Yeah, it freaked markets out. The Swiss market was down 5% yesterday. Our markets got killed yesterday. Today, they're mixed. The Dow is down barely. S&P's flat. NASDAQ's up about 1%. Russell 2000, which is small caps, are up almost 1%. The key is how we close today. I think we're going to close weak because we have a holiday weekend. We've got the Juneteenth holiday on Monday, which is a federal holiday, a new one. I think this might be the first year for it, which is cool. And markets are closed as well. And I don't think anybody wants to be long their book of business over the weekend. So I really look for markets to close weak today. In addition to the Swiss and the U.S., central banks across Europe hiked rates yesterday, which again provided more shock in the markets. My key question is this, is when are central banks going to shift their focus from inflation to economic growth or weakness? That is the question of the hour. I don't know the answer to that. I think that day will come. It's not definitely this month or next. My guess is it's as we get into the summer or even Q3 into the fall. But we'll see. That's another thing we really got to watch. So really keep your eyes peeled there. Okay. Things that make you go, these are so good. They're so good. I'm singing the song. If you're an 80s person like I am and you love 80s music, you know what? There's a great song called Things That Make You Go, and every time I say that, I think about it. First one, quote of the week. This was from Thursday. Fed Chairman Jay Powell said, currently, there are no signs that the U.S. economy is slowing. Emphasis on no. You know what I think of this? I think that's rubbish. That's all I'm going to say. I've been watching some history movies about Winston Churchill and World War II. I love history. So I picked up an English term, rubbish. J-Pal, that is rubbish, I'm telling you. Moving on. Here's a good one. Stats for the week. 30-year mortgage rates have increased to 6.28% this week. That's an increase of 0.75% in 1 week. Okay? And rates have doubled over the past year. Do you think housing is going to slow down? I'll let you think on that one. I'm not even going to answer that. I don't need to answer that one. I just don't need to. Next stat. No shortage in companies with weak fundamentals. What do I mean by that? If you look at the number of companies in the Russell 3000, which are 3,000 companies, it's a 3,000 company index, large cap, mid cap, and small cap. Companies without profits or positive cash flow has increased to nearly 25%. What that means is there are 620 companies in the Russell 3000 that don't make any money. Moving on. Goodbye to the savings boom. This was a big one during the pandemic. Man, people were saving money like crazy. Here is the problem. You know what? And I put the wrong slide up there. I'm disappointed. Anyway, the slide I had was showing saving rates, and saving rates have dropped to 4.4%, which is a number that is in line with the saving rates pre-pandemic. Or no, excuse me, during the financial crisis, which is a big deal. See, I can't even go backwards in my deal, so you can tell how this is uncut and unedited. I just jacked it up, and I can't even go back because then I screw it all up, and I don't want to reshoot this. So anyway, it's crazy times, people. They're very challenging, and I know that. But instead of focusing on the negative, I want you to focus on the positive, because there are lots of positives. In the midst of market turmoil, market challenges, opportunities are being created every single day. And I mean that. You have to believe that. All right. If you have 401k that you're putting money in every month, don't even worry about it. You're buying low all the way down. That is fantastic. If you're working with me, you don't have to worry. We're very defensive right now. We sit in a lot of cash, US dollar, and gold right now. On the equity side, we own a little bit of utilities. We own a lot of high dividend paying equities and dividend growers, and that's it. We're not taking on any more risk than necessary. The bond market is also going to be very challenged here. With interest rates rising, that means interest rates are going to continue to push higher until what happens? They pause or they stop and they begin to focus on the economy. Right now, they're not. That's why I posed that question. When is the Fed going to switch gears and switch their focal point from inflation to the economy and growth? Growth is slowing, and it is going to accelerate to the downside. We have to be prepared for that. We are. I want you to know that, and I don't want you to worry about it. We're sitting there, and I'm watching, and I'm crunching the data every single day, and the opportunities that present themselves, we are going to pounce on when the opportunity is right. Until then, we are going to sit tight and be patient. So anyway, for Wall Street X's and O's for June 17th, this is Craig Modlemog. Thank you for joining me. I always love doing these with you guys. I hope you find these beneficial and helpful. I hope you feel better when we get done. You feel more informed, you feel more educated, and you feel less edgy. Because if you listen to the narratives out there every day, it's rubbish. And on that note, I'm going to end. Craig Modlemog again, Wall Street X's and O's, June 17th, and I am out. Thanks for joining me, people. Later.